Basics of Investing. Chapter 6, Technical Analysis. Section 1, Chart Types. Chart type matters because the same market data can tell a slightly different story depending on how it is displayed. One chart may make the broad trend obvious right away, while another makes intra-period volatility stand out first. That means your chart choice can shape what you notice, and just as importantly, what you might overlook. If you are trying to understand long-term direction, a simpler chart can help reduce distraction. If you're trying to judge timing or price behavior inside each period, a more detailed chart may be better. Technical analysis begins with this simple idea. The data may be the same, but the visual format changes the lens you use to read it. Bar charts and candlestick charts both start with the same 4 price points for each time period: open, high, low, and close. The open tells you where that period began, and the close tells you where it ended. The high and low show the full range of prices reached along the way. Those 4 values give much more information than a single closing price because they show both direction and range. A period could close slightly higher, for example, but still have experienced a wide and volatile swing during the session. Once you understand OHLC, you can read both bar charts and candlestick charts with much more confidence. A line chart is usually the simplest chart type because it connects closing prices from one period to the next. That makes it especially useful when your main goal is to see the big picture rather than every detail inside the day, week, or month. Long-term investors often like line charts because they make broad direction easier to compare across different assets. By leaving out the open, high, and low, the chart removes a lot of visual noise. The trade-off is that you lose information that might matter for entry timing or short-term analysis. So line charts are excellent for clarity, but not ideal when you need precision. A bar chart adds much more detail because each bar shows the full high to low range for the period, along with the opening and closing prices. The left tick marks the open, and the right tick marks the close. That small structure tells you not just where a price ended, but how it behaved during the period. If the close is above the open, buyers gained some ground by the end of that interval. If the close is below the open, sellers had more control. Taller bars usually suggest greater volatility because price traveled through a wider range before the period finished. Candlestick charts use the same OHLC information as bar charts, but many people find them faster to read at a glance. The candle body shows the distance between the open and the close, while the wicks show the high and the low. A bullish candle closes above its open, and a bearish candle closes below it. Because the body is visually larger than the small ticks on a bar chart, shifts in buying and selling pressure often stand out more clearly. That is why candlesticks are so popular with active traders. The important point is that the insight comes from open, high, low, and close, not from the color alone. Candlestick patterns can offer clues about market psychology, but they should never be treated as automatic signals. A doji can suggest indecision because the open and close end up near each other. A hammer can hint that buyers stepped in after price traded lower during the period. An engulfing pattern can suggest momentum is shifting from one side of the market to the other. But a single candle means very little without context. The surrounding trend, the location on the chart, and whether later price action confirms the idea all matter more than the pattern by itself. There is no universally best chart type because each one is better suited to a different job. Line charts simplify the picture and are useful when you care most about overall direction. Bar charts give fuller price detail and can help when you want to see range and open-close information clearly. Candlesticks offer the same detail but with more visual emphasis, which can make patterns easier to scan quickly. A long-term investor may prefer line charts most of the time, while a swing trader or day trader may rely more on bars or candles. The smart choice is the one that fits your strategy and the kind of decision you are trying to make. Take one trading hour with an open at $50, a high at $51, $25, a low at $49, $75, and a close at $50. A line chart would usually show only the close, so you would see a single plotted value at $50 for that hour. A bar chart would show the full range from $49, $75 to $51. $25 with a left tick at $50 and a right tick at $50. A candlestick would show a body from $50 to $50 in wicks reaching up to $51. $25 and down to $49. $75. All three charts use the same underlying data. What changes is how much detail the chart lets you see immediately. 1 point. One bar, or one candle, is only a small snapshot of market behavior. The real value of chart reading comes from placing many periods in sequence and looking for patterns across time. That starts with choosing the time frame, because a 1-minute chart and a weekly chart can tell very different stories about the same asset. Once the periods are plotted in order, you can look for trend, momentum, and volatility instead of overreacting to one isolated move. A single candle may look dramatic, but its meaning often changes when you place it inside the larger sequence. Good chart reading is less about one period and more about the structure formed by many periods together. Beginners often make mistakes by using the wrong chart for the question they are trying to answer. A line chart is great for direction, but it is not the best tool for precise trade timing because it hides intra-period detail. Another common error is reacting too strongly to one candle as if it defines the whole market. Time frame confusion also causes problems, because what looks important on a short chart may be minor on a larger one. With bar charts, people sometimes mix up the open and close ticks, which changes the meaning of the bar entirely. The best habit is to slow down, match the chart type to the task, and always place any single period in context. Section 2. Trends. A trend is simply the market's general direction over time, and it is one of the first things to identify when reading a chart. Prices can rise, fall, or move sideways, and each condition creates a different set of expectations. If you know the trend, you have a basic framework for judging whether a move fits the bigger picture or pushes against it. Many traders prefer to align with the trend because it can improve the odds compared with fighting it. At the same time, trends exist on many time frames, so the answer depends on whether you are looking at an intraday chart, a daily chart, or a weekly chart. Trend does not guarantee what comes next, but it gives your analysis direction. The three basic trend types are uptrend, downtrend, and sideways movement. An uptrend is defined by higher highs and higher lows, which tells you buyers are gradually pushing price upward. A downtrend is the opposite, with lower highs and lower lows showing that sellers remain in control. A sideways market keeps swinging inside a range, without a clear upward or downward sequence. The key idea is that trend is not defined by one strong day or one sharp drop. It is defined by the pattern created by repeated swing highs and swing lows over time. To read a trend, start by marking the major swing points rather than every tiny fluctuation. Ask whether the recent highs are rising or falling, and then ask the same question about the lows. If both are rising, the market is generally strengthening. If both are falling, it is weakening. If neither side is making progress and swings stay contained, the market is probably range-bound. Ignoring minor noise helps you focus on the structure that actually matters because trend analysis works best when you simplify the chart down to its clearest turning points. Not all trends are equal, and two important qualities are slope and duration. Slope tells you how fast price is moving, while duration tells you how long the move has been sustained. A very steep trend can look exciting, but it is often less durable because price has advanced or declined too quickly. A steadier trend with a moderate slope may be more sustainable because it shows orderly progress rather than a sudden burst. Duration matters because a trend that is held together over time usually deserves more respect than one that just started. In practice, the best trends are often not the fastest ones, but the ones that remain intact through normal pullbacks. A pullback is a temporary move against the trend, while a reversal is a true break in the trend structure. In an uptrend, a pullback is normal as long as price eventually holds above the prior higher low. If that higher low pattern starts to fail, the market may be shifting into something weaker. In a downtrend, the same idea applies in reverse. The structure stays intact as long as lower highs keep forming. This is why trend analysis is less about guessing and more about watching whether the pattern still holds. A move against the trend is not automatically bad news, but a broken structure deserves attention. A trend line is a simple visual tool that helps you track direction and judge whether price is still respecting the trend. In an uptrend, you connect rising swing lows. In a downtrend, you connect falling swing highs. Ideally, you want at least two clear swing points to draw the line, and more touches can make it more meaningful. But a trend line should not be treated like a laser-precise boundary. It works better as a zone or reference area where price may react, not as a line that must be obeyed to the cent. A trend line becomes more useful when price reacts to it more than once. 2 touches can be enough to draw a possible trend line, but a third touch often gives traders more confidence that the market is actually respecting it. Each additional reaction can attract more attention because more participants begin watching the same area. Even so, the line is still just a tool, not the whole analysis. Price structure remains more important than the line itself. A well-drawn trend line supports your reading of the chart, but it should never replace the chart's swings and context. When a trend line breaks, it can be an early warning that momentum is fading, but it is not automatic proof of a full reversal. A close beyond the line tends to matter more than a brief intraday move through it. Some traders also pay attention when price closes meaningfully beyond the line, perhaps around 1 to 2%, because that can make the break less trivial. A full candle body beyond the line is often more persuasive than a wick that simply pokes through. Even then, one break can still be false, so a second close beyond the trend line may provide stronger evidence. The message is caution and reassessment, not instant certainty. Trend always depends on time frame, which is why looking at more than one time frame is so important. A daily chart might look weak because price is pulling back, while the weekly chart still shows a healthy, broader uptrend. Starting with the higher time frame helps you understand the larger direction first. Then you can use a lower time frame to improve timing and define entries, exits, or risk more precisely. This prevents you from mistaking a normal pullback for a major change in trend. Good decisions usually come from aligning shorter-term actions with the larger trend whenever possible. If a stock keeps posting rising lows at 150, 158, 158, and 172, while its highs rise from 175 to 182, 190, and 190 that is a classic uptrend. Both sides of the structure are moving upward, which shows persistent demand. You could draw an upward trend line beneath the rising lows to help visualize that pattern. If price then dips to 168, that would still count as a pullback, because it remains above the prior low at 165. The trend does not become weak just because price pauses or declines briefly. But if price begins closing below the trend line repeatedly, that would suggest the uptrend is losing strength and deserves a closer look. Trend analysis works best when you stay objective and avoid forcing the chart to agree with your opinion. One mistake is drawing trend lines backward from the current price, instead of letting the actual swing structure guide you. Another is forcing lines through random points just to create a pattern that is not really there. Many people also mistake every pullback for a reversal, especially when they ignore the larger time frame. And some use trend lines too mechanically, as if one small break automatically changes the whole trend. A better approach is to combine structure, slope, and context, and remember that trend analysis is about probabilities, not certainty. Section 3. Support Resistance. Support and resistance are price areas where buying and selling pressure often become uneven enough to shape market movement. Support is the area where a decline may slow because buyers begin stepping in. Resistance is the area where an advance may stall because sellers become more active. The simplest mental model is a floor and a ceiling, but real charts are rarely that neat. Price can bounce between these areas for quite a while as traders react to familiar levels. These are not guarantees that price must turn, but they are areas where market behavior often changes. In real markets, support and resistance are usually zones rather than exact prices. That is because orders are spread across a range, and traders rarely react at one perfect number. Price may dip slightly below support before recovering, or push a little above resistance before turning back down. Those small overshoots are normal and do not automatically mean the level has failed. Thinking in zones helps you avoid being too rigid. It also leads to more realistic trade planning because markets often test an area rather than touch an exact line and reverse instantly. Horizontal support and resistance often come from prior turning points on the chart. If price has bounced several times near the same low area, that zone may become support because traders remember it and place orders there again. If price has repeatedly stalled near the same upper area, that can become resistance for similar reasons. These zones often reflect places where many buyers, sellers, or profit takers became active before. Round numbers can also matter because they attract attention and often cluster orders. In short, these levels come from repeated market memory, not from magic. To identify horizontal levels, scan the chart for areas where advances or declines stopped more than once. When you find repeated reactions around the same region, mark that area with a narrow zone rather than a razor-thin line. The more cleanly price has reacted there, the more useful the level may be. At the same time, not every minor pause deserves a level. If you mark too many lines, the chart becomes cluttered and less helpful. The goal is to keep only the clearest, most repeated areas where price has meaningfully turned before. When price tests the same support or resistance area repeatedly, that level usually becomes more important in the eyes of traders. More people notice it, watch it, and may place trades around it. But repeated tests can also weaken the level because available buy or sell orders may gradually get absorbed. That creates an interesting balance. A level can gain significance while also becoming more vulnerable. This is why each new test deserves fresh attention rather than blind confidence. A level that held 3 times can hold again, but it can also fail precisely because it has already been tested so often. One of the most useful ideas in chart reading is that support and resistance can switch roles after a breakout. If price breaks above resistance, that old resistance area may later act as support on a pullback. If price breaks below support, that old support may become resistance when price tries to rally back into it. Many traders wait for this retest because it can provide extra evidence that the breakout or breakdown is real. The retest does not always happen, but when it does, it often gives a cleaner decision point. This role reversal helps turn past chart behavior into future reference points. Volume can make a breakout through support or resistance look more convincing when it is stronger than usual. If price pushes through a key level on high volume, that suggests broader participation and often more commitment behind the move. If the breakout happens on weak volume, traders may be more cautious because the move may not have strong backing. The useful comparison is not volume in isolation, but volume relative to recent average activity. Strong volume does not guarantee success, and weak volume does not guarantee failure. But volume is a helpful supporting clue when judging whether a level break has real conviction. Support and resistance are not just for identifying chart structure. They can also help organize a complete trade plan. If you are considering a long trade, support may help define a possible entry area. The next resistance level can help you estimate a realistic target. A stop can be placed just beyond the support zone with a reasonable buffer to allow for normal noise. The same logic works in reverse for a short trade near resistance. Used this way, chart levels help connect the idea, the risk, and the reward into one disciplined plan. Imagine a stock trading around $48 that has bounced near 42 3 different times and stalled near 55 several times. That gives you a workable map, support around 42 and resistance around 55. A trader might consider an entry near 42. 50, place a stop around 41. 20, and aim for a target near 54. 50, the stop sits below support with some buffer because price often wiggles around a level before moving away from it. If the stock briefly dips to 41, 90 intraday but closes back above 42, support may still be holding. This kind of example shows how zones help shape a practical setup, not just a theoretical label on a chart. Support and resistance are useful guides, but they are never guarantees. A common mistake is treating levels as exact numbers rather than flexible zones. Another is relying on weak or outdated levels that no longer matter to the market. Traders also get into trouble by assuming every bounce will work, even when trend, news, or volume are working against the idea. Strong catalysts can push decisively through a level that looked important yesterday. The best habit is to treat levels as part of a decision framework and always combine them with context. A strong way to build skill is to take a recent chart and practice marking a few key support and resistance zones by hand. Try finding 2 support areas and 2 resistance areas that price has reacted to clearly. Then note how many times those levels were tested, whether any role reversals occurred, and whether volume changed meaningfully near those spots. After that, turn one of the levels into a simple trade idea with an entry, a stop, and a target. The goal is not to predict perfectly, but to train your eye to connect chart structure with decision making. Repetition is what makes support and resistance start to feel intuitive. Section 4. Indicators. Indicators take raw market data and transform it into signals that can be easier to read alongside price. They are usually built from price, volume, or sometimes open interest, depending on the market. One reason traders use indicators is to reduce some of the noise that appears on a chart from one period to the next. Another is to highlight patterns that might be less obvious if you look at price alone. But indicators are not replacements for the chart itself. They are tools that support analysis by adding another layer of evidence. Most indicators fall into two broad categories: leading and lagging. Leading indicators try to warn of a possible move before it fully develops. Lagging indicators react after price has already started moving and are often used to confirm what is underway. This creates a basic trade-off between speed and confidence. Early signals can arrive sooner, but they are often less reliable. Confirming signals tend to come later, but they can help filter out some false moves. Neither category is automatically better, each serves a different purpose. Leading indicators are designed to provide early warnings, especially around potential turning points. They can be helpful when momentum appears stretched, and you want to spot a possible shift before price fully confirms it. That can make them attractive for early entries or exits. The downside is that they are more vulnerable to false signals, especially in choppy or trendless markets. A signal may appear, but price may keep moving in the same direction anyway. So leading indicators are often best treated as alerts that tell you to pay attention, not commands that tell you to act immediately. The Relative Strength Index, or RSI, is a leading indicator that measures the speed and size of recent price moves on a scale from 0 to 100. Readings above 70 may suggest price is overbought, while readings below 30 may suggest it is oversold. That does not mean price must reverse right away. It means the recent move may be stretched relative to its recent behavior. In a strong uptrend, RSI can stay above 70 longer than many beginners expect. In a strong downtrend, it can remain below 30 for some time as well. Lagging indicators respond after price has already begun moving, which makes them useful for confirmation rather than prediction. They are often used to answer questions like whether a trend is actually established or whether a recent move has enough persistence to trust. Because they react more slowly, they can miss the very start of a move. But that slower response can also filter out some market noise and reduce the chance of acting on every brief fluctuation. In that sense, lagging indicators trade speed for stability. They are often less useful for exact timing, but valuable for understanding trend direction. A simple moving average, or SMA, tracks the average closing price over a chosen number of periods. A shorter average, like a 10-day SMA, reacts more quickly because it is based on more recent data. A longer average, like a 50-day SMA, moves more slowly and gives you a broader view of the trend. The slope of the average can also be helpful because an upward slope suggests rising trend pressure while a downward slope suggests weakness. Traders often watch for moments when price or one moving average crosses another. Those crossovers can hint that momentum or trend behavior is changing. Comparing a shorter moving average with a longer one can reveal shifts in trend behavior. When the shorter average crosses above the longer one, traders often call it a bullish crossover or golden cross. That suggests recent price action is strengthening relative to the broader trend. When the shorter average crosses below the longer one, it is often called a bearish crossover or death cross. That can suggest weakening momentum or a trend turning lower. These signals can be useful, but in sideways markets they often produce whipsaws, where the averages cross back and forth without a lasting trend. Indicators usually work better together because each one answers a different question. A moving average can help confirm the direction of the trend, while RSI can show whether momentum looks stretched. Used together, they give a fuller picture than either one alone. For example, a stock may be in a healthy uptrend according to its moving average, but an RSI reading above 70 can warn that the short-term move is getting extended. That does not automatically mean sell, but it does improve your understanding of conditions. Even with multiple indicators, context from price, levels, and time frames still matters. A disciplined indicator routine can help you avoid impulsive decisions. First, choose whether you need a leading indicator for early warning or a lagging one for confirmation. Then set clear parameters, such as a 10-day and 50-day moving average, or an RSI with a 14-period setting. After that, watch for the specific signal you care about, like a crossover or an extreme RSI reading. Before acting, look for confirmation from price action, support and resistance, or the larger trend. And finally, connect the signal to risk management by deciding position size, stop placement, and exit rules in advance. Imagine a stock already moving higher in a clear uptrend. If the 10-day SMA crosses above the 50-day SMA, that adds confirmation that shorter-term momentum is supporting the broader rise. If RSI is around 65, momentum looks strong but not yet extremely stretched. Rising volume would further support the idea that more traders are participating in the move. Later, if RSI climbs to 78, that does not erase the uptrend, but it does warn that the move may be overheating in the short run. As long as price continues holding above the 50-day SMA, the broader trend can still remain intact even while momentum looks stretched. Indicator mistakes usually happen when people treat a signal as a complete answer instead of one piece of evidence. One common problem is using a single indicator without checking what price is actually doing. Another is ignoring time frame differences, which can make one chart look bullish and another look weak. Many beginners also overload charts with too many indicators, creating confusion rather than clarity. Overbought and oversold readings are especially easy to misuse because they are warnings, not automatic trade instructions. The best practice is to keep indicators simple, combine them with context, and always pair them with volume awareness and risk management. Section 5. Volume. Volume measures how much of an asset was traded during a specific chart period. In stocks, that usually means shares traded. In futures or other markets, it may mean contracts or units traded. The important point is that volume always belongs to the time frame you are viewing. On a daily chart, volume shows daily trading activity. On an hourly chart, it shows what happened during each individual hour, which means the same asset can have very different looking volume depending on the chart period. Volume matters because it helps you judge how much participation stands behind a price move. Price tells you what happened, but volume helps you ask how widely supported that move may have been. If many market participants were active during the move, it can appear more credible. If price moved sharply on very light activity, traders may be more cautious about trusting it. Volume does not tell you direction by itself, and it does not predict the future on its own. Its real value is as supporting evidence that adds context to price. The same price move can mean something different depending on the volume behind it. If price rises and volume rises too, that often suggests stronger buying interest and broader participation. If price falls while volume increases, that can point to stronger selling pressure. A rise on low volume may still continue, but it has weaker support because fewer traders are involved. A decline on low volume may signal only limited selling pressure rather than widespread conviction. These are tendencies, not guarantees, but they help you interpret the quality of a move rather than just its direction. Volume is especially useful when price is trying to break through support or resistance. A breakout on strong volume usually gets more respect because it suggests more market participants are committing to the move. By contrast, a breakout on light volume may be less convincing and more vulnerable to reversing quickly. That is why traders often watch key levels and volume together rather than separately. If resistance breaks on expanded volume, the move may have real traction. If it breaks quietly with little participation, caution is often the better response. Volume divergence happens when price keeps extending its move, but volume does not confirm with equal strength. For example, price may make a new high while volume is lower than it was on the previous high, or price may make a new low while the volume behind that decline is lighter than before. In both cases, participation is fading even though price is still moving. That can warn that momentum is weakening, but divergence is not a reversal signal by itself. It is simply a clue that the current move may be losing support. A single volume reading means very little on its own unless you compare it with what is normal for that asset and time frame. That is why traders often use recent average volume, such as a 20-day or 50-day average, as a reference point. One large volume bar might look important, but if the asset often trades at that level, it may not be unusual at all. News, earnings, or other catalysts can also create one-time spikes that distort the picture. Volume should always be read in context, not in isolation. And on most charts, you will see it displayed as a histogram underneath price. A simple volume process can keep your analysis consistent. Start by reading volume on the time frame you actually plan to use. Then compare current volume with recent average volume so you know whether activity is normal or unusual. After that, match volume to price behavior by asking whether participation confirms the move or diverges from it. Finally, check whether the move is happening at an important support or resistance area, and whether recent news may explain the activity. This step-by-step approach makes volume much more useful than just glancing at a few bars below the chart. Suppose a stock usually trades about 2 million shares a day and then breaks above $45 after earnings, closing at $47, 50 on 5, 2 million shares. That resistance level near 45 had already been tested several times, so traders were clearly watching it. Earnings provided a visible catalyst which helps explain why interest suddenly expanded. If you divide 2 million by the normal 2 million, you get a volume ratio of 2, 6 times average. That suggests strong participation behind the breakout. It does not guarantee the move will continue, but it makes the breakout more credible than one that happened on ordinary or weak volume. A common mistake is focusing on the price breakout while ignoring whether volume confirms it. Another is assuming every big volume spike is bullish or bearish by itself, when sometimes it simply reflects exhaustion or reaction to news. Traders also get misled when they compare raw volume numbers without considering what is normal for that asset or time frame. And volume can be misused when it is studied alone without support, resistance, trend, or chart context. The basic rule is that volume should support analysis, not replace it. Used carelessly, it can create false confidence just as easily as it can provide clarity. A useful practice exercise is to review a recent large move in a stock or ETF and test whether volume actually supported it. Start by measuring the size of the price move. Then note the volume on that day and compare it with the 20-day average. You can even calculate a simple volume ratio by dividing the day's volume by the average. After that, ask whether the move happened near support, resistance, or in the middle of a trend. This turns volume reading into a repeatable process instead of a vague impression. The key idea is that volume measures participation, not direction, by itself. Strong volume can add weight to a breakout, a trend continuation, or a reversal attempt because it shows broader involvement. Weak volume can make the same price move look less reliable, especially at important chart levels. That is why volume is most useful when you combine it with trend, support, and resistance and overall chart context. Think of price as showing the move and volume as showing how many traders are standing behind it. Together, they give you a more complete picture than either one alone.